perhaps just take a few examples to illustrate our approach. Well, one company I think is very unique is Walt Disney. They have great brand name. They own the Star Wars franchise. They own, of course, all those historical stars like Mickey Mouse and Winnie the Pooh, and they bought Marvel a few years back. And I always say that Mickey Mouse has three great qualities. First, he's highly popular and known all around the world. Second, he's immortal. And the third, he has no agent. So you really own your star. And that's a great thing for Disney. And the uniqueness of business model of Disney is that they have these big movie blockbusters, and like Alice in Wonderland in 1951, and then 50 years later they can redo a new version and make money again with the same name. And they did that recently with the Jungle Book. They released their first animated version in 1967, and they did a real live version last year, which was also a big success. So it's kind of like owning an oil field where you take all the oil, and 50 years later you go back to the field and there's even more new oil to take out, and you don't need to spend money on capital and pay people to guard your field. It's really an extraordinary business model. We bought that stock probably 11, 12 years ago. I think in 2005 we paid about $24, and it was the day that Bob Iger was named CEO. And we've done it since then. So there was a period when the stock did not do much. As you can see, for 4 years the stock didn't do very well, but earnings kept growing, and we were patient. And if you look over the 12 years we've owned the stock, earnings have grown about 13% annually. And in the end, the stock has more than quadrupled. So if you're patient and companies grew their value, eventually the stock will follow. I want to take another example of a stock that's been a while in the portfolio, Carmax. It's been 10 years in the portfolio. And as you can see, earnings per share have grown at about 16% annually since we bought it in 2007. And the stock has done very similar, even though the P ratio is a little lower today than when we first bought it. We first bought it in the summer of 2007. At that time, the P ratio was about 24 times. We bought more shares in 2011 at 14 times, and more shares in 2016 again at 14 times, and today the stock is about 18 times earnings. So even though the P ratio has been reduced a bit over the years, the stock has done pretty well. It's done about 13% annually, even though earnings grew about 16% annually. And that's about 5% better than the S&P 500. Dividend included has done about